Team, welcome to Chapter 1 on Multinational Financial Management and Overview. I suggest taking this lesson up in parts, taking up to a maximum of 8 to 10 slides per sitting. In this chapter, we will identify the main goal of the multinational corporation, or MNC, and potential conflicts with that goal, as well as describe the key theories that justify international business. We will also differentiate the role of an international manager with that of a domestic manager. What is the main goal of a company? It is to maximize shareholder wealth or build shareholder value by increasing the value of his or her ownership through a stock price increase or sharing of profits in the form of dividends. One way to find out how well companies have performed is to go into Bloomberg.com, then type the name of the company one wishes to follow in the search box. In this slide, you will find the price of one share of Capri stock for the day is $42.45, which is lower than its 52-week average price next to the green arrow, and its 1-year return on the stock investment is almost 20%. Try looking up your favorite company as I did in slides 5 and 6. When a corporation's shareholders differ from its managers, a conflict of goals can exist. This is called the agency problem, which is the cost of converging managers' goals with those of the company's shareholders. For example, hypothetically, Global Clothing Company, GCC, based in Amsterdam, has a subsidiary in Bangkok that sources its silk fabrics from Thailand. GCC can get a discount on its worldwide supply of silk from a Chinese manufacturer, but its Bangkok operation refuses to agree to the plan because its costs will increase because it will need to pay tariffs and transportation costs for Chinese silk that it currently does not need to incur for Thai silk. Thus, time and energy will be spent convincing the subsidiary in Bangkok to acquire more costs to benefit the company's global operations. Agency costs are normally larger for MNCs than for purely domestic firms due to the difficulty in monitoring distant managers in different countries, the different cultures of foreign managers, the sheer size of the larger MNCs, and the tendency to downplay short-term effects. So, subsidiary managers abroad may be tempted to make decisions that maximize the values of their respective subsidiaries instead of the company as a whole. The magnitude of agency costs can vary with the management style of the MNC. A centralized management style tends to reduce agency costs because a central manager communicates the goals of the firm. However, a decentralized style gives more control to those managers who are closer to the subsidiary's operations and environment. Some MNCs attempt to strike a balance by allowing subsidiary managers to make the key decisions for their respective operations, while the parent's management monitors the decisions. Today, electronic networks make it easier for the parent to monitor the actions and performance of its foreign subsidiaries. Companies reduce agency costs by offering stock compensation, which gives employees incentives to act as owners of the corporation, because shareholders tend to focus on the return on their investment rather than other priorities that non-shareholding employees might have. While they are not really motivators for wealthy people, the point of our lesson is to include every team member in this pay package to entice him, her, or them to act in the interest of the company as a whole, that is, create shareholder value. Anticipating a threat of a hostile takeover, which forces employees to streamline operations and focus on sales that add shareholder value. We will learn more about this concept in Learning Unit 7 when we discuss the Gucci LVMH case study. Monitoring and intervention by large shareholders. For example, once an activist shareholder questioned Target Corporation's credit card business by suggesting to sell it so that the company could focus fully its attention to what it does best, retail. While management explained that credit card purchases in other stores enabled them to stock the stores with goods customers bought elsewhere, the activist shareholder eventually prevailed, with the company eventually selling its credit card business to JP Morgan Chase. MNC managers are confronted with various constraints, such as environmental constraints, such as one encountered many years ago by Walmart in Germany, where its smiling cashiers were regarded by customers to be flirting with them. The retailer's one-stop shop concept was spurned since the Germans prefer to shop in different stores, and its employees winning a lawsuit to allow them to pursue personal relationships with one another. Regulatory constraints, such as the limited store hours encountered by Toys R Us when it initially opened in Japan, and ethical constraints, which a study found has cost some $34 trillion in foreign projects lost by U.S. businesses in 30 years due to differences in ethical practices. For example, in the West, there is a strict interpretation of bribes, while in other cultures, it may be regarded as an expected way to complement one's livelihood. This can be subjective. For example, you are on a business trip abroad, and the immigration officer there accidentally loses your passport. You hand the officer $40 to facilitate locating your papers. Is this a bribe or a tip? Some would say this is a bribe, while others would say it is a tip, because it merely facilitated the immigration officer to do his, her, their job, which is to allow your entry into the country. A bribe could be more to influence someone's action, like a vote on a bill that would benefit one or one's firm. Do you see the subtle difference? A recent study found that investors assigned a higher value to firms that exhibit high corporate governance standards and are likely to obey ethical constraints. So why are firms motivated to operate internationally? One explanation may be the theory of comparative advantage founded by David Ricardo. Before we go into that, let's take a step back and discuss the theory of absolute advantage originated by Adam Smith, also known as the father of international trade. Smith theorized that nations, owing to the quality of their resources, must produce the goods they create most efficiently and import those it does not. Ricardo refined this theory by stating that even if nations produce the goods more efficiently than other countries, it should still focus on making the goods it creates most efficiently, because specialization by countries can increase production efficiency and enable people and entities to consume more than its country produces. Ricardo assumed that the only factor of production was labor hours. So the theory goes, if there is a total of 100 labor hours, England takes 2 hours to produce 1 unit of wheat, and France takes 4 hours to make the same item, then England would have the comparative advantage to produce wheat. Likewise, If England takes 4 hours to produce 1 unit of cloth and it takes France 2 hours to manufacture the same good, then France would have the comparative advantage of producing cloth. If each country were to produce both goods, the chart shows that they would only be able to consume a total of 70 units of both products, because if England consumes 20 units of wheat and it took 2 hours to make each one, then it would have consumed 40 of the 100 labor hours. That is, 20 units times 2 hours equals 40 hours. So, with 60 of the 100 labor hours left, it could only manufacture 15 units of cloth because it takes 4 hours to create each one, or 60 hours divided by 4 hours equals 15 units. The same thing is true for France, except that it would be able to produce 20 units of cloth and only 15 units of wheat. See the graphs in this slide showing the scenarios described in slide 16 in the blue line for England on the upper graph and yellow line for France on the lower graph. However, if England wants more cloth and France would like to produce more wheat, what should it do? Each country could do so by England focusing on 100 hours purely on producing 50 units of wheat, as depicted in the red line in the upper graph, and France manufacturing 50 units of cloth as depicted in the red line on the lower graph. See the updated numbers in the slide indicating total production consumption increased from 70 in slide 16 to 100 in this slide. This shows that by specializing on products they produce most efficiently, the countries can consume more than they produce. A second explanation is the imperfect markets theory established by Paul Krugman, wherein companies or regions like Silicon Valley, due to their efficiency in producing certain goods, can tend to monopolize production of certain goods, creating an imperfect market as opposed to a perfect market which has a lot of competition that make it more difficult to manipulate product price. Labor, technology, land, and capital, all collectively called factors of production in this case, are immobile. Unrestricted movement of these factors would promote equal costs and returns, removing the comparative cost advantage. For example, if Vietnamese laborers can easily be transported to the United States and paid accordingly to their wage in Vietnam, then the need to move production to Vietnam may be less compelling. Of course, there are other costs to consider, including logistics, taxes, etc., but they are not part of this theory. A third explanation is the product cycle theory, conceived by Raymond Vernon, that postulated as a firm matures, it may recognize additional opportunities outside its home country because it will need less innovation, less skilled labor, less capital, and lower pricing. For example, during my banking days many years ago, I bought a personal computer for $3,000. Can you imagine that? They were made in the United States. You will see in the first graph that between time 0 and time 1, only the most advanced country is manufacturing. However, as the product matures, production shifts to the less advanced, then the less developed countries, as the second and third graphs show, because less innovation, skilled labor, capital, and pricing are needed. Of course, these days, the US is no longer the only most advanced country, and some less developed countries are themselves actually introducing innovative products. If one one compares the downward sloping jagged lines comparing the returns of a purely domestic company with those of a multinational company, we can find that the multinational company has higher earnings. Likewise, in comparing the upward sloping curve representing costs, those of the multinational companies tend to be lower. Because investment and financing opportunities of multinational companies as compared to purely domestic companies are marginally greater, and they tend to be more profitable. In practical terms, it is no different from Nike being able to source its sneakers in China to lower the cost of its products. Likewise, Zara is more profitable than some of its domestic competitors because of its global presence. To review slide 22, the marginal returns on MNC projects are above those of purely domestic firms, since MNCs have expanded opportunities of possible projects from which to select. Likewise, MNCs can obtain capital funding at a lower cost due to their larger opportunity set of funding sources around the world. An international financial manager faces more business challenges due to foreign exchange rates, foreign economies, and political risk. To see the effect of foreign exchange risk, compare the rupee rates for the currency price quoted at the top and bottom halves of the slides. We will learn to convert the value of one currency to another in Learning Unit 3. In summary, an MNC will decide how much business to conduct in each country and how much financing to obtain in each currency. The MNC's financial decisions determine its exposure to the international environment. An MNC can control its degree of exposure to exchange rate effects, economic conditions, and political conditions with its financial management.